Let's take a moment, look at the disclaimer. This content is for educational, informational, entertainment purposes only, and nothing should be taken as a recommendation to buy, sell, or hold any securities at any time. We are here just to tell you how BTA analyzes the market, how we look at the markets, but nothing should be taken as a recommendation. This is Rod from BTA, and we are known as the middle traders. Now, what we're going to do here is this is part two of walking with the market. And we call it walking with the market because we want to stay in tune with the market, right? We want to follow the major market indexes. We want to walk with it. We don't want to follow too far behind it because then you miss the move, okay? So we want to try to walk in step with it. We want to stay in step with the market, walk with the market, okay? And that way, if we can do that, okay, if you can walk with the market and stay in step with the market, then you're probably going to be right on 75% of all that you can do, all that you do. Because if the major market indexes are going up, okay, and you're long, okay, then you got a 75% chance of being right because 75% of all of the securities are going to follow the major market indexes. So if the Dow Jones is going up, 75% of all the stocks in the Dow Jones is probably going to be going up. If the Dow Jones is going down, 75% of all the stocks in the Dow Jones is probably going to be going down. So why would you want to try to go against the direction of the major market index and try to pick the 25% of stocks that's going to buck the trend? Well, that doesn't make any sense. Or buck the swing? Well, that doesn't make any sense. To us, it doesn't make any sense. We rather walk with the market. We rather stay in step with the market. We rather stay in tune with the major market indexes and give ourselves the highest probability of success. So we got to walk with the market. All right. So we did part one. This is part two. All right. And we have a daily chart of the Dow Jones Industrial Average. This is the guppy. Okay. We're going to start with the guppy for part two. So let's maximize this, zoom in so you can see it. So right now you got the guppy here, daily chart of the Dow Jones Industrial Average, the actual index itself. And here, the magenta line of closing prices. All right. And we have our shorter term, faster moving averages in green and our longer term, slower moving averages in red. Notice that the magenta line of closing prices had gotten above all of the faster term green moving averages, and they twisted. The green moving averages twisted and started to move upward, and they started to expand a little bit. But the magenta line of closing prices, okay, had found turbulence inside of the longer term moving averages. They can't get above it. If the magenta line of closing prices is finding turbulence there and starting to break back down and get inside of the faster, shorter term moving averages of prices, okay? Well, that's not really what we want to see. We want to see the magenta line of closing prices getting above these longer term downward trending red moving average lines. And then we want to see all of these moving average lines turning up, okay? So if you notice, before the magenta line of closing prices got above all of the shorter term faster moving averages back here. But once it got up to the longer term moving averages, the last time, okay, we've been in this bear market, this downward correction for quite a while now. But the last time that the magenta line of closing prices got above all the green faster moving averages, well, it got right to the longer term moving averages and got rejected and fell apart. Okay, now we're at it again. The only difference between the last time and this time is that at least the faster term moving averages, the green moving averages, did twist. They started to twist right here. You can see it. And they started moving to the upside and expanding. Well, we didn't get that twist to the upside back here the last time. Okay, if you look right here, we didn't get that twist to the upside last time. The magenta line of closing prices got above it, but the green faster, longer term moving averages kept pointing down. Okay, so we need to see if the magenta line of closing price is going to find support inside of the green shorter term moving averages and make its way back up and get through these red longer term moving averages. Okay, so right now for the Dow Jones Industrial Average, the guppy is telling us that we still are pointing more downward, and we moving sideways into some kind of consolidation right now. We got to see if we're going to get outside of this turbulence. Right now, the daily chart for the Dow Jones, the guppy, is saying, hey, we caught in between the longer term and shorter term moving averages. We don't have any clear direction right now. We have to see how this is going to play out. So we have to watch this chart and see if the guppy, the magenta line of closing prices, are they going to get back below these longer term, these shorter term, faster green moving averages, and that will be a bad sign because that means prices are probably going to continue to go down, especially if these green moving averages twist back down like they did over here, where they twisted and expanded to the downside. We don't want to see that. Okay, or are we going to find support back inside of the faster green moving average and break back through the turbulence of the red longer term moving averages on the Dow Jones? So that's what we're going to be looking at. Where is the magenta line closing price is going to go? Up or down below the faster, or up above the longer term red moving averages? Now, let's minimize this back and let's see what the Standard & Poor's 500 is telling us, right? Well, it's a similar picture. Just slightly worse, but it's a similar picture, okay? And the reason I say it's slightly worse is notice that the magenta line of closing prices, be back on the Dow Jones right now. This is the Dow Jones Industrial Average. The magenta line of closing prices still hasn't broken back below the longer term, this bottom longer term red moving average right here. Okay, it still hasn't broken back below that yet. It's inside of the longer term moving averages. Okay, and inside a little bit of the green faster moving average, but it hasn't broken below the lower long term moving average, the bottom red line. It hasn't broken below that on the Dow Jones. Okay, so that's looking a little bit better than the Standard & Poor's, because if you look at the Standard & Poor's, let's reduce that. Let's go now to the Standard & Poor's 500, okay, and let's maximize that so you can see it. Let's zoom in a little bit. Okay, notice we below the lower red line on the Standard & Poor's 500. Here's the lower line, lower longer term red moving average on the guppy. That's the upper, but lowers that price. The magenta line of closing price has gotten below the lower red longer term moving average. We broke back below it. So we broke back out of the turbulence. We came back out of it. So the Dow Jones hasn't done that yet. It's right there, but it hasn't done it yet. So this is not good for the Standard & Poor's. We don't want to really see the price breaking back out of it, because we wanted it to, if it got caught in this turbulence, we wanted to make its way back up and get up above the upper red line, the longer term key moving average, okay? Longer term red moving averages. So right now, for the Standard & Poor's 500, we got a similar picture to the Dow Jones, except for it's just slightly worse because we broke back below. We back out of all the longer term moving averages to the downside, okay? But for the most part, okay, we kind of caught inside of the turbulence, inside the area indecision. We stuck in between the longer and the faster, the green faster moving average and the longer term red moving average. We kind of stuck in between all of that, and we're in the area of indecision. We are not above or below all of the longer term and short term key moving averages. Okay, so if I reduce this a little more, okay, if I reduce this a little more, you'll be able to see what I'm saying. Okay, let me bring this down. Sorry about that. And let me reduce this just a little bit more here for you so you can see exactly what I'm saying. All right. And let me bring this down. Let me clear some of this up for you. And let me expand this just a little bit. Okay. I'll bring this up a little bit. All right. So what we want to see, all right, what we want to see is the magenta line of closing prices getting above everything. When it's above everything, well, that's stronger to the upside. When the magenta line of closing prices is below a downward trending green and downward trending red moving average, well, that's more bearish. That's not good. That's not what we want to see. Like over here, see the magenta line of closing prices are below all of the green and the red moving averages, and they all pointing down. Well, that's not what you want to see. Okay, so that's what I mean. We want to see price. We at an area indecision right now, right? We at an area indecision right now where the magenta line of closing prices are stuck in between the longer red moving averages and the shorter term green moving averages. That's not really what we want to see. Okay, it's in the area indecision right now. We want to see it get out of this, and all of the longer term red and green moving averages start turning up. And eventually we want these faster, longer term green moving averages to get above, if prices are going up, to get above these longer term red moving averages. Okay, so we want to see that twist and expansion to the upside. But right now, we find the turbulence in the longer term red moving averages, and we kind of pointing down, and we just broke below the lower red longer term moving average. Not that great. Hopefully we don't break below the green, totally below the green, and start moving back down. Well, that's not that good. So that's the if that happens, that wouldn't be that great. Okay, so that's the Standard & Poor's 500. So the Standard & Poor's 500 is in the area indecision. It's looking a little worse than the Dow Jones. We're back below all of the red longer term key moving averages. Are we going to get rejected at those key moving averages and move lower and get back below the green? Well, that's what's to be seen. And the Nasdaq is also looking a little worse than the Dow Jones also, because it is below all of its long-term red moving averages also. Okay, let's expand that. Let's zoom in so you can see it. Here's the red downward trending, okay, longer term red moving averages here. And once again, here's the bottom of the longer term red moving averages. You see the magenta line of closing prices are back below it, okay? And we inside of the green, all right? So, and we heading down trying to get below the green, okay? We're not there yet. We're halfway there. So as the magenta line of closing prices break back below the faster, shorter term green moving averages and start turning down and start moving down, well, that's not good, okay? We don't want to see that. If that happens, then maybe it's going to come back down here and test these lows of the closing prices back here. Okay, these lows. We don't want to see that. You see here, when the magenta line of closing prices tried to move up the last time, it got rejected, got back below the green, short, faster moving averages. Well, we trended down pretty good. We don't want to see that. If that happens, then the momentum prices are definitely starting to move back down. We don't want to see that. All right. So right now, the Nasdaq, all of the key indexes, according to the Guppy, is starting to have some issues. Right. We finding turbulence. We finding resistance inside of the longer term red moving averages. We're starting to break below the red longer term moving averages. We're back inside of the green. That's not good. If we break back below out of the green moving averages, then yeah, we might. The Guppy is telling us that the momentum might be trying to shift back to the downside, and we might go back to test the lows. Okay. So with all of this happening, this is why you notice that if you gotta try to stay in step with the market, you don't want to try to get courageous and try to go long and buying a lot of things because of things you might be hearing on the news or Twitter or whatever the case may be on YouTube. Listen, stay in step with the market, walk with the market, follow the major market indexes, not too far behind it. Don't follow too far behind because then you're going to miss the move. Try to walk side by side with it. Okay, stay in step with it. Stay in tune with it, and you'll be okay. So that's the Guppy for all the major market indexes. So as you can see, to sum it up, the Guppy is finding resistance, finding turbulence inside of the longer term red moving averages. starting to break below the longer term red moving averages, starting to get back into the green. The red and the green moving averages are kind of tight next to each other. There's no gap in between it. Okay, if it's trending down and you see a gap between the red and the green moving averages, well, that's a lot of momentum to the downside. If it's moving up and you see a gap between the red and the green moving averages, well, you got a lot of momentum heading to the upside. Right now, we kind of inside of each other. We squeezing each other. There's no gap. The magenta line of closing prices are inside of everything. A little area indecision. The market hasn't decided yet. We saw on part one, we saw that we were inside of a sideways channel for the last week. Okay, areas of indecision, inside days, and things of that nature. So the guppy right now is confirming all that. Now let's go now to the market breadth. This is a daily chart of the total U.S. market, the percentage of stocks above the 200-day moving average in the total U.S. market. All right, and right now we're at 20. Only 20% of the total U.S. market is above its 200-day moving average. Here's our 40% level right here, this red horizontal line. When you get below 40 and you start trading below 40, well, you might be heading into correction. When you get down here in the teens, below 15 and stuff like that, like this here area here, well, that's starting to get to extremes, okay? But right now, we're in bear market territory. We only got 20% of the total U.S. market above its 200-day moving average. Well, that's not good, okay? That's bear market stuff, all right? We well below the 40 area, so you're well below where you have to be for a correction. You're definitely in that, okay? No doubt about it. But right now, we at 20%, okay? This is Friday's closing, Friday's daily bar, okay? And it stopped right at 20%. So 20% of the total U.S. market is above its 200-day moving average. Well, if this market is to rally back to all-time highs or back to the high of the day of the inverted yield curve, well, guess what? There's no reason to have FOMO. No reason to fear that you're going to miss out on anything, because you still got quite a few stocks, okay, below their 200-day moving average in the total U.S. market. Only 20% of the total U.S. market is above its 200-day moving average. And this chart monitors about 10,000 stocks, okay? For the total U.S. market, we monitor about 10,000 stocks here. So you can do the math. It's a lot. It's a lot of stocks, a whole lot of stocks. The majority, well over the majority of stocks, are below their 200-day moving average. And we below this red horizontal support line, the 40% level. You get below that, you're definitely in correction territory. We're in bear market territory right now. We're in the 20s, okay? Now, this is the Standard & Poor's 500, the percentage of stocks below the 200-day moving average for the Standard & Poor's 500. I'm going to zoom in so you can see that. Well, we're at 30%. Only 30% of the stocks in the Standard & Poor's 500 is above its 200-day moving average. Only 31%, I'm sorry. 31.8, so you want to round it up to 32, that's fine too. But it still sucks, all right? So only 32% of the Standard & Poor's 500 is above its 200-day moving average. Here's the 40% level, this red horizontal level, which acts as support. When we start getting below that, okay, we definitely in correction territory. There's no doubt about it. When we start getting down here in the 20s, well, and getting below 30, well, you're definitely in bear market territory for sure, all right? But right now, the Standard & Poor's 500, okay, only 31% of the stocks is above its 200-day moving average. It's a lot of stocks still below. This index has a lot of room for improvement. Only 31% of the stocks is above its 200-day moving average. If this market is to rally, I'm going to tell you again, you got a lot of stocks that still got to get above their 200-day moving average and start moving. There's no reason to fear that you're going to miss out on anything. If this thing is going to go, It's a whole lot of stocks that got to start, the charts has to start improving. It's a whole lot of stocks out there. Out of 500, the Standard & Poor's 500 got 500 stocks in there. Only 31% of them are above their 200-day moving average. It's a lot of room for stocks to improve. So there's no reason to fear. All right. Right now, the market breadth is still really bad. So this is telling us that the majority of the stocks are not participating. Okay. So here the Nasdaq percentage of stocks above the 200-day moving average in the Nasdaq. And right now we at 17.8%. So you want to round it up to 18%? That's fine too. But it's still bad. Okay. You're down here, only 18% of the Nasdaq is above its 200-day moving average. There's over 3,000 stocks in the Nasdaq. Okay. Only 18% of them is above their 200-day moving average. Okay. So you know what Paul Tudor Jones said. If you're above the 200-day moving average, I'm going long and only long, not short. If you're below the 200-day moving average, I'm going short, not long, or I'm going to be sitting on the sidelines. Well, only 18% of the Nasdaq is above its 200-day moving average. All right. So that is definitely bear market territory. You see the 40% level, the red horizontal line way up here. Okay, way up here. You get below 40, you're definitely a correction. You start getting down here below 20 and getting into the teens, yo, listen, straight up, you're in bear market territory, okay? So, look, even though we're looking for a rally, we're looking for a bounce, some type of relief rally, and we definitely think that we're going to go back before the recession hit. We believing that we're going to go back to the high of the yield curve inversion date, okay? Not because we just think that. Well, it has done that every time in history. We had an inverted yield curve, the market collapsed, then it rebound, go back to the high, at least to the high of the inverted yield curve date. Then we start seeing job losses, people getting fired. The unemployment rate starts to increase. And the recession hit and the market collapsed. Happened like that. That's the cycle. It happens like that every time. It has happened like that every time. Okay, we had an inverted yield curve convergence. So we still believe that, hey, if it happened like that every time in the past, then it's probably going to happen again. Well, if it don't, you got to prove me that is not going to happen. You got to prove it to me. Okay, I'm not going to sit here and go against history. Okay, you got to know where you came from to know where you're going. All right, so I'm going on the side of history. If this is going to be the one time that it doesn't work, well, I can live with that. But I'm not going to buck it. All right. So right now, to sum it up, the percentage of stocks above their 200-day moving average, okay, are very low. And that's telling us that it's not a lot of participation to the upside. Most of the stocks, the majority of the market breadth, the stocks inside of all the major indexes are still really looking really poorly. Their chart structures are looking really poorly because the majority of them are below their 200-day moving average. So there's no need to fear. There's no need to worry about missing out on no rally. Little pops here and there, 1 day up, 2 days up, 1 day down. It doesn't matter. The longer term trend, the breadth of the market, walking with the market is what we want to do. Okay. Right now, the percentage of stocks above the 200-day moving average is still looking like bear market, definitely correction, bear market territory. Okay. So now, let's just look at this chart here. We're going to go straight to the Nasdaq. Okay. So the Nasdaq, this is a chart that shows us the number of stocks hitting new highs, new 52-week highs, and new 52-week lows. Up here, this is the number of stocks hitting 52-week highs. Down here, this is the number of stocks hitting 52-week lows. Okay, all right. So this is for the Nasdaq, the Nasdaq right now. So on Friday, we had 37 stocks hitting new 52-week highs, but we had 133 hitting new 52-week lows. Okay, 133 hitting new 52-week lows. And just to reiterate what we said, okay, on Thursday, On Thursday, okay, this is why you got to watch this. You got to walk with the market, y'all. Here on Thursday, we had an up day, okay? That was a strong up day on Thursday. But I brought it to everyone's attention. That on Thursday, we only had 32 new 52-week highs. It was an up day, right? It was a strong up day, too. The Nasdaq closed up almost 3%. We only had 30 new 52-week highs, but we had 141 new 52-week lows. So if it was such a strong, powerful up day on Thursday, I said that to y'all. Isn't it interesting that we had such a strong, powerful up day on Thursday, but we still had almost 3 times the amount of 52-week lows? All those stocks are hitting new 52-week lows. Well, of course, maybe you might have more 52-week lows than 52-week highs because the trend is still down. But shouldn't the number of stocks still plummeting to new lows, 52-week lows? Shouldn't it have been at least low? I'm not saying it should have been higher than the number of stocks hitting 52-week highs, because maybe that many stocks are not hitting 52-week highs right now because it's been going down for so long. But still hitting 52-week lows, more than 5% of the Nasdaq, plummeting to new 52-week lows on such a strong up day. I told you that's a day to make you say, what's going on? Okay, well, guess what? On Friday, we still had 133 stocks hitting new 52-week lows. So it's still almost, this blue line, this little blue crayon line, that's kind of hard to see inside of this histogram. Okay, this little blue crayon line is at the 5% level. When 5% of the Nasdaq is hitting new 52-week lows, is that little crayon line. Up top, the little crayon line up top is 5% of them hitting new 52-week highs. So it's still a lot of new 52-week lows. Stocks are still hitting new 52-week lows, y'all. They still doing it, okay? That's not really that great, all right? We don't really want to see that, all right? So now, let's finish it up with our go-to market breadth indicator, the advancing minus the declining stocks, the differential, right? The differential chart. Advancing minus the declining differential chart, all right? Well, the green line is still well above the red and the yellow. Well above it, okay? So that's good. We did get our little green arrow, all right, that gave us the green light that said, hey, by the way, this is the daily chart of the Dow Jones. Advancing minus declining issues differential, our invisible chart, right? So we did get our little green arrow telling us that, hey, the Dow Jones may start rallying up a little bit, all right? And it did do that, okay? But now, right now, it's still, the green line is still above the zero, still above our red line, the zero line, right? And it's still above the yellow and the red. But the yellow and the red does not seem to want to start pointing up. And actually, the yellow moving average line of this differential chart has now broken back below zero. That's not really what we want to see, okay? If that continues, soon the green line is going to start getting back down here. Remember what I said before, okay? The best, notice the best signals are when the 21-day and the 50-day moving averages is trending up. In other words, the green and the red, the yellow and the red, the yellow and the red, the yellow, the 21-day moving average of this differential chart, and the red is the 50-day. When they both are pointing up, while the green, which is the 9-day average, is up and well above zero, and these two start pointing up, those are the best signals, okay? We haven't really gotten that. If you notice, ever since the green arrow, where the green line has gotten above the yellow and the red and got above zero, okay, and the yellow started turning up, we got a little green arrow. The red line has not been able to get and start turning up like the green and the yellow. That's not what we want to see. That's not the best signals. So right now the yellow is starting to break below. So we got to watch out with the Dow Jones. Okay, we might be starting to lose momentum. We might be starting to lose momentum on the Dow Jones. Okay, so now let's look at the Standard & Poor's 500 advanced decline line differential chart, the same chart, our invisible chart. Okay, let's look at the Standard & Poor's 500. All right, here's the Standard & Poor's 500. We're gonna zoom in so you can see it. And once again, the green line is above the yellow and the red. It is above our horizontal line, our horizontal resistance level at the 0 line. So the green is above the yellow and the red, and it's above the 0 line. But the green is starting to move back down. The yellow is back below 0, and the red is totally flat. That's not what we want to see. So this is showing a little more weakness in the chart. Okay, a little more weakness, saying that Standard & Poor's 500 may be starting to lose some of its momentum also. So it's starting to weaken. Our advanced decline differential invisible chart is starting to weaken, and we haven't really seen the best signal yet, where that red and the yellow both start pointing up with the green. Okay, we haven't seen that. So now let's look at the Nasdaq, and the Nasdaq looks the worst. All right, so let's zoom in so you can see it. The Nasdaq looks the worst. Okay, we did have the green line got above the yellow and the red, and it got above our resistance level at 0. It got above that. But if you notice, the yellow line never got above 0, neither did the red. And the red has constantly been flat to down. Okay, and so only the green has gotten up above 0 and tried to move upward, but the red is totally flat and down. That's not what we want to see. That's not the best signals. Okay, so this is also showing a little more weakness, a little more weakness now, and we never really got our best signal. So to sum it up, for our advanced decline differential invisible chart, our go-to breadth indicator to catch moves off of the bottom. Right now we got our green hours on all three. That was true. The green line got above the red and the yellow and above 0. That's true too. We did get a little pop. We caught a follow-through day. The market ran up for 2 or 3 days. That's great. But our best signals, we still didn't get the best signal on these advanced decline differential chart. We still did not get the best signal where the red and the yellow started turning up and moving up with the green. We never got it. And now the yellow is crossing back below the red, getting back below 0. The Nasdaq, it never even got above 0. Okay, it never even got above 0. You can see that over here. It never even got above 0. And then in the red and yellow never really started to trend up. The red never got going and moved up to the upside with the green and the yellow. So we never got our best signals, and the advanced decline, the differential chart is starting to get a little weaker. That's basically telling us that the advancing stocks are not really surging through and past all of the decliners. And so we can really get that pop. All right. It's not that much participation right now. It didn't really get going. Okay. So we want to be careful, and it's starting to weaken now. And we don't want to see that weakness. Okay. We don't want to see that weakness. So stay in step with the market, walk with the market. This was part 2. Go back and look at part 1. Okay. You got to stay with the market. So we seeing consolidation in part 1. We saw the consolidation. We saw the inside days. We saw all of that. All right. In part 2, we seeing that is the guppy is showing us we caught within turbulence. We caught between the longer term and shorter term moving averages. Basic consolidation, no real power to either side. In part 1, we saw the resistance and support levels of the highs and the lows of the weekly consolidation. Now in part 2, we're seeing the market breadth is weakening. We see that it's not a lot of participation of stocks that's getting above their 200-day moving average. We still well down low in low areas of correction and bear market territory. And now we're seeing the advanced decline charts starting to weaken. So what's that's telling you? be careful. All that is telling you be careful. All right. Don't get too overzealous, because don't be getting too anxious. Don't fear that you're going to miss out on anything. Watch the charts. Walk with the market. Okay. Right now, the market is telling us it's starting to weaken a little bit. Okay. And it's stuck in indecision. It's stuck in indecision, and it's not really showing us which way it wants to go yet. We got to walk with it. All right. So this is part 2. Look at part 1, take notes, write it down. Look at part 2, take notes, write it down. Get your little sticky pad, put it on your desk, keep it in your wallet, keep it in your pocket, whatever it takes. But keep this stuff on the front of your mind. So when the market open next week, you start looking at them prices going up and down. Start back looking at what's happening on your notes that you took. Is anything really changing, or is those numbers just going up and down and trying to mess with your psyche, mess with your emotions? Okay, so this is part 2 of walking with the market. Okay, take care, y'all.